Today I'm going to reveal what my £230,000 multi-asset investment portfolio pays me every single month. I'll share down to the exact penny exactly what I'm earning, what my highest paying investment is, how these investments align to my current financial goals, and what my plans are for the future to gradually increase my investment income over time. But before we dive into the content, guys, this video is for educational purposes only and is not financial advice. Nothing within this video is an investment recommendation. Always do your own research, and when you're investing, your capital is at risk. So before I go on to reveal all of the numbers, first I wanted to share a little bit of context about me and my portfolio. My income generating portfolio is made up of 4 core assets. We've got individual stocks, exchange traded funds, money market funds, and currently 1 investment property. And here is the percentage split of the value of these assets as things currently stand. Now, the individual stocks and the ETFs I own personally through a stocks and shares ISA account, which I hold with Trading 212 and Vanguard. Whereas the buy-to-let investment property and the money market funds, which I have on Lightyear, are owned through my limited companies. So whilst technically it's all of my own money, because obviously I own the companies, the investments that I hold within those companies are obviously subject to tax. However, the investments that I own personally are not subject to tax because they're in a tax-advantaged account. For the purpose of today's video, though, to keep things simple and to be fully transparent, I'm going to provide all of the figures to you pre-tax. My accountant obviously sorts my limited company taxes out for me, and that's kind of beyond my pay grade, so I'll leave that to him. So with that context out the way, now let's dive into the personal investments which I have that pay me an income. Now, of the 8 individual investments I have on Trading 212 and Vanguard UK, only 4 of them pay me a dividend. Now, a dividend is a portion of the company's profits that it pays out to shareholders, usually on a regular basis, like every quarter, and essentially it's a bit of a reward for owning shares within the company. And now you might be thinking, well, why do only 4 of your 8 investments pay you a dividend? Why don't all of them pay you a dividend? Well, this kind of links into my personal investment strategy and the investments I hold within my portfolio. Right now, my own personal investment strategy is very much geared more towards growth. That's probably a bit of an age thing and a risk tolerance thing where I can take a little bit more risk within my investment portfolio in order to essentially achieve higher capital growth as the years roll on. And for now, I'm a little bit less interested in investments that are a little bit more of a stable value that can provide me with a stable income. And of course, that's a very personal approach to me and how I go about my own investments. In light of that, some of the stocks which I own are more growth stocks. So those companies, instead of paying out dividends to shareholders, instead they retain those earnings within the business, reinvest into the business in order to achieve future growth. And it's that growth that I'm prioritizing within my investment portfolio and its value, rather than looking for companies or funds, let's say, that are paying out, high dividends once a quarter or even perhaps monthly. So now you have a flavor of that. Now let's talk figures. I'll show you the latest payments, which are all quarterly, and then we'll annualize them. So we've got a little bit of an idea as to what that works out to be on a monthly basis. So first off, I've got a Vanguard S&P 500 ETF, which is held across 2 ISAs, as I've said, on Trading 212 and Vanguard UK. And on Trading 212, I have 298 units, and over on Vanguard, I have 180 units for a grand total of 478 units within this fund. Now, this fund is a weighted index which gives you exposure to the top 500 companies in the United States of America, essentially captured all within one single fund, with some of the bigger weightings of this fund being the likes of Apple, Amazon, Microsoft, Nvidia, and Meta. Now, in terms of the dividend yield on this one, it's fairly small at just 1.11%, and here is the dividend distributions per share over the past couple of years. You can see it's generally trending upwards, but it's not a high dividend paying investment by any stretch. What that means for me then in terms of my income, well, over on Trading 212, my last dividend payment from this fund was £73.92, and over on Vanguard it was £44.57 for a grand total of £118.49 for the quarter. On a monthly basis though, this works out to be roughly £39.50 per month, so let's add that to our running total. The next income generating investment that I have is a Vanguard FTSE All World ETF. Now there is quite a bit of duplication here with the S&P 500 ETF which I have, because about 60% of the value of this fund is actually weighted towards the US stock market, with the remaining 40% giving me exposure to the rest of the world, which is why I have it within my portfolio. With some of the other larger positions being held in countries like Japan, the UK, China, France, Canada, and Switzerland. So if the US market does ever decline and these other markets potentially perform better, then the weightings will be readjusted to reflect that current performance. So I'm hedging my bets, if you like, against the US market downfall in case that ever happens. Now, in terms of my current holdings, well, I currently have 85 units right now, where there is a quarterly dividend being paid out with a yield of 1.6%. Here is also the dividend distributions for this fund over the past couple of years, where you can see generally they're fairly stable, with the exception of the half-year dividend typically being much higher. And there are a couple of reasons for this spike in dividend at the half-year point. Firstly, European companies often have a biannual or an annual dividend payout, meaning when those payouts come around, they're typically higher than what you would expect from a quarterly payout. Secondly, Japanese and some Asian firms lean towards more of a fiscal year-end dividend, which is often in Q2. So in June, this fund typically receives a larger wave of dividends from non-US companies, meaning that during that period of time, there's typically a larger than usual distribution of dividends to ETF holders, which is obviously good for me because we've got another big dividend payment due at probably, I think, the end of next month. In terms of how much that works out for me, though, in terms of pounds and pence, well, in Q1, I received a dividend of £22.30, which works out to be roughly £7.43 a month, which we'll add on to our counter. But if we just take a quick look at that larger dividend payment, which we receive on a half-yearly basis, well, looking at last year's figures, which was about 79 cents a unit as a guide, if we multiply that by my 85 units, then my next dividend payment will be roughly $67, which is about 50 quid or so, and I'll certainly be pretty chuffed with that. Now, both of these funds are the distribution version of the fund, meaning the dividends are paid out to me into my brokerage account rather than reinvested back into the fund instead. Now, this is a personal choice, but I would rather have those dividends paid out to me in cash than I could choose what I want to do with them, because as of right now, whilst my priority is to reinvest those dividends, actually in 20 or 30 years from now, I actually might want to withdraw that dividend and take it as cash from my portfolio completely tax-free. To demonstrate further why I take the dividend in cash and then reinvest it, I've actually found a research paper from Hartford Funds. And it shows the impact of reinvesting dividends versus just the price return of the S&P 500 index between 1960 and 2024 on a $10,000 investment. They conclude that over 64 years of reinvested dividends, the value of that portfolio would be $6,399,426 versus just $982,072 if the investor withdrew all of their dividends and just spent it willy-nilly. So for me, dividend reinvestment is the way to go right now in order to better compound the value of my portfolio over time. Aside from those two funds, I do also have two other individual stocks that also pay out a very small dividend too. First up, we've got Apple, who pay dividends on a quarterly basis, with the last dividend being paid out at 26 cents per share. And as I only own 54 shares, the last quarterly dividend payment that I received was £8.98, the equivalent of £2.99 a month. Then finally, we have Metastock, another small dividend payer, with the last dividend payout being 52.5 cents per share. This resulted in another small dividend paycheck of £5.86, which would be the equivalent to £1.95 per month. So that's my personal stock portfolio, which works out to be a grand total of monthly dividend income of £51.87 a month on average. Certainly nothing huge, perhaps the equivalent to a date night once a month, and that's probably without alcohol too. Now let's move on to my limited company investments, where the income values stack up just a little bit better. Let's start off with the BlackRock Money Market Fund, which I hold with Lightyear. Now, a money market fund is a low-risk investment that gives me a place to store some spare company cash where I can typically get a higher rate of return than a traditional savings product. That's because money market funds typically buy short-term debt off governments, banks, and companies that have strong balance sheets and a strong credit rating in return for a rate of interest. Now, the rate of interest that I'm currently getting on my money right now is 4.41%, where I'm currently holding £27,025 in this account. I've only had this account for 2 months, but you can see the current interest that I've earned has been £101.47 so far. But based on my current account value and based on this Bank of England calculator, when I plug in all of the figures, actually it'll work out to be that I'm earning £99.33 a month, assuming a stable balance, of course. So let's add that £99.33 to my monthly income figure. I will likely continue to use this money market fund to invest some of my spare business cash, because otherwise that money would have just been sat in a bank account doing nothing, probably getting eroded by inflation. Then finally we have my buy-to-let investment property, which is owned through a separate limited company. It's a one-bed flat which I bought back in 2023 for £112,000 as a bit of a turnkey buy-to-let. Right now the property rents out for £895 per calendar month, and I also have it managed by an estate agent, so when we withdraw those estate agent fees, well, here's the notification of the amount which I received today, which was £809.08. However, it's important to note that this property is also on an interest-only mortgage, which works out to be £391 a month. As it's a flat and a leasehold property, I also have service charge to pay too, which based on my most recent statement, which I've literally just paid, it worked out to be £1,361.52 for the past 6 months, which works out to be £226.92 a month, meaning the profit on this property works out at £191.16. However, we must also account for some other general expenses like insurances, general maintenance, even like your electrical safety certificates, which come around every so often. So to account for this, let's take off a nominal amount of £30 a month, taking the total income for this property to £161.16. My plan is to add a couple more investment properties to my portfolio over time, as it's where I personally see a good amount of potential for a decent amount of monthly income to be generated, especially if I can get slightly better loan to value on the properties which I own. I will say there are quite a few downsides to owning investment properties. However, with my first one, I've got to say I've been quite lucky. The tenants have looked after the property, and they've all paid rent on time every single month. So because of that, it's kind of given me the confidence to go on to actually secure a second investment property, which I'll share some of the details on as soon as it's gone through with solicitors and with exchange contracts and I have the keys in my hand. All in all, when we add all of this together, the average pre-tax monthly income from my £230,000 investment portfolio works out to be a grand total of £312.36, the equivalent to £3,748.32 a year. I'm not sure whether you think that's good or bad, high or low, but it is certainly reflective of my current investment strategy, which is probably more geared towards growth than it is for cash flow and monthly income. But of course, be sure to let me know what your thoughts are down in the comment section below. But before you go, if you're interested in learning how to construct your own investment portfolio for long-term growth, then be sure to watch that video next. With that being said, I'll see you over in the next one.